Welcome to the second panel, and following up on the excellent first panel focusing on European capital market developments. We'll now take you on a journey from Riyadh to Hong Kong, Washington and Milan, to explore how different markets are unlocking growth, building investor trust, and also adapting to a changing global financial landscape, as we heard in the first panel. As you heard, our panel represents some of the world's most dynamic capital markets, from advanced hubs to fast-growing emerging economies, as well as the global policy and market infrastructure level. So without further ado, I suggest we jump into the thick of it, and starting with the CMA President of Saudi Arabia, Mr. El-Kuwaiz. Saudi Arabia has opened its market to foreign investors and undertaken a very wide-ranging reforms over the years. And from your perspective as a CMA President, which single change has been the most transformative for market depth and investor confidence so far? Can you maybe quickly share with us a few key milestones achieved in developing your equity and debt markets over the years? I appreciate it's a very wide a set of questions, and how these reforms are positioning your kingdom as a global financial hub.
So thank you very much, David. It's a pleasure to be here with so many illustrious colleagues. You are in fact correct. Saudi Arabia has had a significant amount of capital market development, particularly over the last 10 years. And just to put it into perspective, the country has actually gone through possibly one of the most rapid rates of financialization anywhere in the world, in any short time span, I would argue, in history. And just to put it into perspective, in 1 year, we moved from roughly 70–80% market cap to GDP to close to 300% market cap to GDP in 1 year. And that was the year 2019. And the year 2019 happens to be the year in which we listed our crown jewel, Saudi Aramco, which is the most, still today, the largest and most valuable IPO in history. Continues to be the largest company in our stock market, but interestingly enough, its proportion of our market cap has actually declined with time. When Saudi Aramco was listed, it represented about 75% of our market cap, which explains the big jump in 1 year. But very rapidly, other sectors, other businesses started to catch up. And since 2019, we have been doing something like 40 to 50 IPOs a year. And that level of activity was actually an order of magnitude different from prior to the listing of Saudi Aramco. And so much so that actually today, even though I mentioned Saudi Aramco still remains the largest company in our stock market, it used to represent about 75% of our market cap. Today it represents maybe about less than 65% of our market cap. And it's a combination of the value of Saudi Aramco has declined, obviously, with lower oil prices, but also a plethora of new IPOs and listings. And the reality is, this financialization has not been a luxury for us. It was a necessity. And the reason it's a necessity is because a lot of people know about Saudi Arabia's biggest export. Probably everyone knows, oil. Few people know what our second biggest export is. Would anyone like to guess? Some people say dates, etc. Actually, our second biggest export is capital. Saudi Arabia, since the oil boom, has had an economic model where we generate economic surpluses, foreign exchange revenues from selling oil, and then we have more abundance of capital than opportunities to invest. So we were always a net exporter of capital. As a result of a blueprint that came out in Saudi Arabia in 2016 called Vision 2030, the main emphasis of which to diversify the Saudi economy away from our reliance on hydrocarbons, which necessitated that we restructure our economy, we restructure our public sector, and indeed we restructure our society and the way we interact as a society. So it is quite aspirational, and that actually is what I would say was the biggest change that made a difference in Saudi Arabia. Because last night when we were having dinner with His Excellency the Minister, a common theme has been how difficult it is to implement reform in the public sector. And that becomes even more difficult when you talk about multilateral organizations and aligning different countries. And one of the most important tools, at least we have found, is to write things down. Having a blueprint gets everyone aligned, gets the order and the sequence aligned, gets people to fight in the beginning, hopefully, so they don't fight at the end. And the most important thing is gets the sequence, an order of things correctly. Because if you are in any development path, the destination for almost all countries is almost the same. Pick a global best practice anywhere from any rule book, and they'll tell you what the best capital market looks like, what the best financial system looks like, what the best economy should look like. What they don't tell you, which is really the most difficult part, it is what is the right sequencing of events and what is the right order of events. And that will probably be very different from one country to another. And let me give you just one example for me to end. We tend to have, in Saudi Arabia, very concentrated ownership in our stock market. In most developed markets, you tend to have very fragmented ownership. When we first opened up our market to international investors, we were very curious to see how the rest of the world views our concentrated ownership. And interestingly, we found that most global investors, most institutional investors actually quite liked big anchor investors because they believe that this is aligned with the long-term interests of the firm. It doesn't lead to short-termism, etc. But it creates a very strong caveat. And the strong caveat is there are very, very many concerns around minority shareholder protections. And so, unsurprisingly, in Saudi Arabia, we became one of the most strict markets probably in the world, almost draconian, with respect to minority shareholder protection. It's not because we are solving to a destination, it's because we believe that is the best reform that is needed to emphasize our strength or areas and to protect us from our weakest areas leading to our common path to growth.
Thank you very much, Your Excellency. That's indeed a very impressive trajectory in recent years. Find it quite eye-opening also to reflect on the number of IPOs in your domestic market. So now moving from Saudi Arabia to Hong Kong, Christopher. Hong Kong obviously plays a unique role as a super connector in global capital flow. So in today's shifting geopolitical environment and financial climate, what is, in your view, the most effective way to strengthen capital flow links between Asia, Europe, and Hong Kong?
In fact, when I look at the composition of this panel, I suppose I should be the one that is farthest from Slovenia, because the flight for me from Hong Kong to here is the longest. So I suppose I can take a hopefully more objective view in terms of how things are here and what things should be. I enjoyed the first panel very much in the sense that it came with a lot of problems. But to me, I very much agree with the Commission's point of view that rather than focusing on a problem proposition, we should focus on an opportunity proposition. I think that's exactly where you're coming from, about how Hong Kong, Asia, in particular, Middle East, even Europe, can work more closely together. I think if you look at more broadly how Hong Kong capital market has come about, right now, in terms of GDP, just now Mohammed mentioned about GDP, our stock market is around like $6 trillion US, the market cap. It's around like 14 times our GDP. And also at the same time, talk about new listings. Lately, we have 16 new listings. And the IPO size is around $17 billion US. And of course, things don't change overnight. We started off of our exchange as a very local exchange, mainly focusing on financing companies, banks, and also property companies. But we started to change back in the early 1990s when we changed our listing rules to accommodate the coming of the Chinese companies, which originally were state-owned. Imagine, for state-owned enterprises in China, they could be not just operating businesses, they could own a school, hospitals, and kindergarten for their employees. So basically, it is a mini society in its own right. And at the same time, to talk about shares protection, as mentioned by Mohammed, everything is state-owned, state-controlled. So we need to ensure that when they come to this in Hong Kong, it's international standard. They have to comply with our Articles of Association and also relevant company laws. And we did that. And since the early 1990s and up to like early 20th century, what we see is a lot of Chinese companies try to get capital from abroad and also to finance their operations in China. I think it's very logical in the sense that it was the time when the Chinese economy is growing. At the same time, there is a need of capital to grow the domestic economies. But things start to change again lately, because what we see is now not just the external capital, international capital, going through Hong Kong into the mainland, but rather is the Chinese companies getting so big that they want to use international capital to go international. For example, lately we have a cartel, which is a major electrical vehicle battery manufacturer of the world, essentially. They raised $5 billion in Hong Kong in their IPO. And 90% of the proceeds actually go to their Hungarian plant. So I think it's very much representative of how our capital markets have been evolving. From one that's serving the Chinese economy, but now is helping the Chinese companies or the other companies as they see it to go international and to finance the international expansion. And of course, Chinese economy do not have monopoly of our market. We welcome other players. That's why lately we also have companies from ASEAN. There is a coconut water producer. Suppose anyone who's in Thailand will drink that. Also listed in Hong Kong. And also we have a copper mine operator from Kazakhstan listed in Hong Kong. And previously we also have Prada listed in Hong Kong. So what I'm trying to say, and also in response to your question in a very long-winded way, is that we have to have the right regime to accommodate international companies to find financing through Hong Kong. Either they are using capital to develop business in China, or it's about Chinese companies going abroad, or international companies try to source international capital for their own expansion. Because after all, our platform is neutral. We provide our services to whoever, whichever, which meets our requirement. Of course, most welcome Aramco as well, if you're interested. And also at the same time, we have to ensure that the robustness and also our standards are in line with global ones, in such a way that we can draw global capital to come to Hong Kong. Referencing the discussion just we had on the first panel, I suppose capital markets is not just about equity. It's also about bonds. And that's why the reason Hong Kong has seen so many bond issuances, in particular green bond issuances lately, is because a lot of the even foreign governments are starting to issue green bonds in Hong Kong. Because through such bond issuances, they can access to international investors, which otherwise would not be available in a domestic jurisdiction. Just to give you some figures, in terms of the green bond issuances in Hong Kong, it's more than $40 billion last year. And if you talk about the proportion of that as part of the Asia total, basically it's more than 45%. And the reason so many entities, be it the government, companies, and even multilateral organizations, come to issue bonds in Hong Kong, firstly because many of them opt to use renminbi for bond issuances because the interest rate there is lower than the US dollar. And also at the same time, they can get access to the global investors through roadshows, through promotion of their national development programs, so on and so forth. So what I'm saying is that our process in terms of how to make Hong Kong grow as a capital market is to make sure that we have international players, either issuers or investors, and also we have international standards which are in compliance with global requirements in such a way that there's a strong momentum going forward as we push the market reforms.
Thank you very much, Christopher, and your comments, which also illustrate the necessity to adapt to circumstances of capital markets players. Now moving to James and the IMF. Welcome, James. As the institution tasked with safeguarding global financial stability, share with us your views on how the IMF views the resilience of emerging and advanced capital market in this very volatile environment and fast-changing environment, as we heard also in the first panel today. And maybe what reforms do you see the most urgent for Europe to strengthen its competitiveness and investor confidence compared to other geographies such as North America or Asia? James, please.
Thank you, and thank you for the invite to be here today next to such distinguished speakers. My work at the IMF focuses on capital markets development and regulation. This is something I've been looking at for over a decade in national governments, regulators, and on the industry side as well. So I know that's obviously a topic close to our hearts today. And all views that I express today are my own, don't necessarily reflect the official view of the IMF, its directors or member countries. So firstly, we're seeing markets change across the globe, a trend towards private financing and, of course, an increasing interest in crypto assets. It's an important time globally, but also particularly here in Slovenia and the EU. So in response to the question about emerging and advanced economies, they both play a critical role in global financial stability and also a critical role in global economic growth. And financial market interconnectedness has grown both between sectors, but also across borders. Many capital markets have so far remained resilient against the backdrop of geopolitical changes, inflationary pressures, and tightening monetary policies. And emerging markets have faced heightened vulnerabilities due to external shocks, capital flow reversals, but so far robust reforms and prudent macroeconomic policies have weathered their ability to absorb shocks. On advanced economies, they benefit from generally more developed regulatory frameworks, deeper liquidity, a more diverse investor base, but of course that doesn't make them immune from the risks of contagion risk or asset price corrections. So across all markets, strengthening market resilience is important through strengthening market infrastructure, transparency and risk management, and these will enhance resilience. But you asked about the comparison between the US and Asia. I think it's important to say that the regions are all very different. The US benefits from a dominant financial ecosystem, scale, depth of liquidity. Asia is rapidly technologically innovating and attracting global capital. And I think the benefits for Europe, as we heard on the previous panel, are very much in furthering integration and reducing fragmentation. So I mentioned my specialisms particularly around regulation, but taking a more elevated view, I'd reference the IMF's most recent regional economic outlook for Europe, which highlighted the opportunities for further integration, but particularly focused on opportunities for labour market reform to have a more integrated labour market, making the European energy market more integrated and affordable, also capital market reforms, which we'll talk about today, and I think the Commissioner mentioned on the last panel the opportunities of a 28th regime to bring an opportunity for more common corporate and insolvency standards across Europe. So these would increase the opportunities for integration, but would probably also make the European economy more resilient to shocks. And at a technical level, this is something we looked at this year in the IMF's financial assessment of Europe, the financial sector assessment, or FSAP for short. This did reference, again, the opportunities for integration, which are very well documented, and highlighted some of the questions that European policymakers need to address. But it also identified more technical areas on the regulatory side where there's opportunities for integration as well, in areas such as stress testing, centralization of data functions, and also strengthening the supervisory and institutional powers that can be afforded to some of the European authorities. And it noted that, referencing the point on sequencing that you referred to earlier, when strengthening those institutional and supervisory powers, it's important to have a destination in sight, but to do it in a phased and careful way to ensure that you know where you're going. So I don't think there's a simple answer to the question, and it blends fiscal policy, economic fundamentals, as well as capital market reform. But I'd reference the things that we mentioned in the regional economic outlook for Europe around integration of the electricity market, the labour market, developing a 28th regime. These are really key. And on the regulatory side, it can sometimes be less exciting, but things like centralizing data functions within supervision and strengthening some of the powers of those European institutions is important. And I think that could provide a very strong footing from which European markets, and indeed more broadly, could succeed.
Thank you very much, James. Indeed, no easy answer and no one-size-fits-all answer either. Very interesting. Moving now from the IMF to MTS. Angelo, welcome. Thanks for being with us today.
Pleasure to be here.
Where capital flows meet execution now. So MTS plays a crucial role in European fixed income market. Christopher also mentioned the fixed income market in Hong Kong. In your view, what innovations or reforms are proving most impactful in deepening liquidity, improving transparency, but also attracting a more diverse set of investors across Europe? Angelo, please.
So I think, I mean, in addition to innovations and reforms, I think it's worth also mentioning recent developments in the way the market environment has changed, especially over the past 2-3 years. It's really worth pointing out, especially the bond markets, which have been highly impacted by it. The disappearance of quantitative easing has made a huge difference to what we've seen over the past 3 years in terms of activity, in terms of liquidity on our markets. You know, when there is a big buyer of last resort in any secondary market, that will distort trading dynamics. It's arguable, I think, that the disappearance of that policy, and if you like, you could almost call it a reform, even though it hasn't been quite so deliberate, has stimulated, from what we can see, a much more genuine and authentic interaction between buyers and sellers of these of financial instruments, especially debt instruments and sovereign debt instruments, which is the core business that we deal with. And this is also closely associated with the interest rate environment, which, you know, during QE was, especially around in Europe, but elsewhere too, hovering around the zero mark or indeed the negative mark, and therefore didn't really provide the kind of trading opportunities that are attractive to traders. We now see interest rates, broadly speaking, and you know, this being quite a high-level conference, I'm not going to get into the minutiae of it, but interest rates now and yields are in the not high area, but certainly material, and provide enough space for traders to do their thing. And this has been, again, as a third component of this picture, has been also volatility. Volatility that has been provided by the uncertainty and some events taking place, whether geopolitically or on a global level, or indeed on a regional or on a national level. And that has also supported the increase in activity that we've seen. I would add to that management office policies. In the business that we work in, we know, and we have plenty of evidence to show for that, and you know, considering that as an electronic platform, we can look at a lot of data points. All other things being equal, the way a debt management office positions itself with respect to the market and how it calibrates its primary dealer incentive frameworks will have an impact on the levels of liquidity and transparency and efficiency in the market, for better or for worse. Another basic component of this is the levels of issuance. Again, for better or for worse, borrowing is high and doesn't look like it's going to come down anytime soon, and that in itself, because of the nature of the debt market, size matters, and that is increasing, and that supports liquidity as well. And finally, in terms of innovation, there has been a relatively high degree, especially more recently, of technological evolution in terms of connectivity and telecommunication infrastructure, where we are seeing more and more bond trading houses become more and more sensitive to latency, access to data, as well as the evolution of algorithms that become more and more refined and therefore produce ultimately more transactions. So I think that covers, I hope, a picture that is complex, and also complex more than anything because of the interaction between all these elements.
Thank you very much, Angelo, and thank you very much for reminding us also of that QE era that is not that far in the past has led to certain normalization also of trading. We now move to a chapter that would be that was touched upon also by a previous panel, which is more like integration versus fragmentation. We turn to the question of market connectivity again in an increasingly multipolar financial world. Are we heading towards deeper integration of capital markets or greater fragmentation? I guess the question is, the answer is probably in between. And what does that mean for your country or institution? We heard the Commission loud and clear as to the aspirational objective of further integration at the EU level. And on this topic, we will start with Christopher. Again, a rather broad question. What strategies, in your views, have been the most effective in maintaining your competitive edge, particularly in attracting international investors and fostering innovation? And how do cross-border listings, in your view, and an investor mobility factor play into your outlook?
I think the word connectivity is huge, and it can exemplify in different forms. And as a government or as a market operator, I think our role is to make sure that we are doing the right thing on the supply side, to ensure that there are sufficient avenues in the connectivity context in such a way that whoever, driven by their own demands, want to use it, they have the right revenue or the right tool in their hand. In that context, I think we can define connectivity in a number of ways. Number one, as you said, is at a company level, cross-listing. Right now, our stock exchange, for example, had allowed more than 30 countries of jurisdiction to be listed on exchange. And also at the same time, we have signed MOUs with more than 20 exchanges, including European exchanges, of course, to allow cross-listing, and also with Tadao as well. So I think the idea is that at a company level, we want to ensure that whichever see benefit tapping in our own market, they can be able to be listed on exchange. And the added benefit of listed on exchange is that apart from benefiting from a local liquidity, they can also benefit from the mainland liquidity, because we have a connect program to mainland, i.e. the money investors that the mainland has can use the connect programs to buy our shares direct without the need for them to open accounts with our domestic brokers. And likewise, for our Hong Kong investors and global investors, they can use their global network to access the mainland market without the need for them to open accounts domestically in the mainland. So I think it's an added plus at the company level why they should choose Hong Kong. Another connectivity angle, as manifests itself, is not at the company listing, but at the liquidity level, in terms of how we can channel liquidity to different markets. Just now, Commissioner mentioned about having a unified pool across Europe, yet at the same time have multiple entry points. I think that's exactly what we have been doing in terms of having more ETFs being listed in different markets, referencing the other markets that we're interested in. Like, for example, lately we have 2 ETFs referencing the Hong Kong stock market listed on Tadao. And likewise, we have in Hong Kong a ETF listed in Hong Kong, yet referencing the Tadao exchange. So I think this is a proven concept and also instrument being available to allow investors in different markets to access companies listed on others. And the reason that ETF is a good tool or the good starting point is that we are talking about a basket of stocks here. If you want to move capital or savings from banks, which originally starting off is due to conservatism or others are kept in banks, you can't really push them outright. You have to provide them with the right tools and instruments to incentivize them. And having ETFs that are widely diverse in terms of ownership, at the same time allowing them to invest in a broad spectrum of companies with common themes, I think is the right angle. So there's another exemplification in terms of how connectivity is being shown in our market at the ETF side. And another angle, apart from connectivity at the company level, connectivity at the liquidity level, is about a more deeper integration, like the Connect program that we have with our own country. Because right now, for the equity market, Hong Kong's is linked to Shenzhen and Shanghai. And in fact, in the market cap, more than 80% of each of our markets are already opened up to the other investors. i.e. the mainland investors, they can invest direct in our shares without coming to Hong Kong. And likewise, for us to invest in the domestic mainland market. And the key is we have to make sure that there's sufficient differentiation into what we can offer. Like, for example, in Hong Kong, we have casino stocks, which are not available in the mainland. At the same time, in the mainland, they also have some stocks which are not found in Hong Kong. So there's every incentive for the investors to go to the other market for asset diversification. So another added plus in terms of Connect program is it is highly possible in terms of being multipled in different asset classes. Right now, in terms of the Connect program, it's not just confined to equity. We have Bond Connect already. And also we have ETF Connect. And more likely, we will put in the REIT Connect as well to enable the real estate investment trust to be included in the Connect program, the mainland. And the reason that we put that in as well is back to about differentiation. The REIT in Hong Kong market is more about data centers, more about commercial buildings or hotels. But those in the mainland are more about infrastructure, roads and bridges. So even though the concept itself is similar, being REIT, underlying assets are hugely different. So again, back to your point about connectivity, while at the same time we try to integrate or try to connect different markets through company listings, ETF launches, and also at the same time liquidity channeling programs like Connect programs, it's very much down to the point in terms of how we can differentiate ourselves in such a way that there's sufficient demand driven by different investors to come to our market to buy what they want to buy.
Thank you very much, Christopher, for this very rich answer. It's a very similar question for you, Mohammed. How is Saudi Arabia developing its market infrastructure and governance to enhance and further boost its global competitiveness? Specifically, how do you see cross-border listing? I think Christopher's intervention was really interesting on that front, and investor mobility evolving to further integrate your markets with also Europe, Asia, and other parts of the world.
Well, thank you very much, David. I talked about earlier a lot of the activity, at least in Saudi, having originated in a blueprint document that came out in 2016 called Vision 2030. And it was actually that blueprint that identified that for the first time, Saudi Arabia is likely to move from a net exporter of capital, which we talked about because of the structure of our economy, to a net importer of capital for the first time in our modern history. Now, first, this is understandable, is if we have more abundance of capital than opportunities to invest, then it doesn't really pay you much to have an open capital market to the rest of the world, because if you do, then that may actually create asset bubbles, because you have even more liquidity than you know what to deal with. So unsurprisingly, that coincided very early on in our process, is opening up our market to the rest of the world. We were effectively an insular capital market. We were one of the few remaining capital markets in the world that was not open to external investment. The same is true, as a matter of fact, in our tourism industry. We didn't allow foreign tourists. So Saudi Arabia was very much, from a capital side, from a people side, was very much an insular economy. So recognizing the importance and the need to move from a net exporter of capital to a net importer of capital means we need to be increasingly open to the rest of the world, because we don't have enough capital to finance even our own financing need, even though we've had a huge amount of capital reserved over the last few years. Now, this transition has manifested itself in two, I would say, parallel tracks. One is an openness with the rest of the world. And so we, for the first time, opened up the Saudi market to international investment. We started with a QFI regime, qualified foreign investor regime. And over time, we have been gradually deregulating that QFI regime. Our hope is very soon we'll probably even eliminate our QFI regime as we've grown more and more familiar with international flows and their implication in terms of risk management standpoint. The other parallel track is actually within the region, regional flows. And in listening to the previous panel, particularly the discussion around the EU, Saudi Arabia and countries in the region actually have a very similar pan-regional structure called the Gulf Cooperation Council. The EU is 27, 28 countries. We are 6 countries: Saudi Arabia, Kuwait, the Emirates, Qatar, Bahrain, and Oman. And as a matter of fact, we may even have more in common amongst each other than European countries have amongst each other. We share the same language, we dress the same, we have the same lineage, the same ethnicity, we intermarry a lot. So it's quite natural to see regional integration in the spirit that we have seen in the EU post-World War II. And for many, many years, this has actually gone full steam ahead in very, very similar fashion as the EU has. We now have free movement of labor between GCC countries, we have free movement of capital between GCC countries, and we have a full-fledged customs union between tariffs, etc. However, at the same time, as we have started to see different countries within the Gulf Cooperation Council grow at different trajectories and different paces, and this first started with the UAE, massively growing as a result of its reform program, and more recently we've seen this as a result of Qatar and Saudi Arabia, it became more difficult to insist on cross-regional integration, because essentially you are asking certain countries, certain member states to slow down for the sake that other member states are likely to speed up. In Saudi Arabia's case, it's even more interesting, because for a long time we were actually the slowest growing country in the region. Now we are among the fastest, but we are also the largest. So we are aware that there's that element of shadow when you're talking about cross-regional integration, that it's very difficult to talk about it when you're the largest country in the region. But in spite of this, we still see progress go on both the regional integration and the international integration at the same time. And so it's not really one at the expense of each other, but we see them move in waves. There are certain times when we see a lot of emphasis and a lot of rapid growth on the regional side. Sometimes you see it sort of quiet down and try to absorb the changes that have been made and sort of to try and digest them, and you see different countries move in individual course. So I wouldn't say that it is one or the other, it's that you have different tools depending on where the wind is blowing that day. If the wind is pan-regional, we have a portfolio of pan-regional things that we work on. If the wind is more individual, you also have an agenda, and you sort of just pick the right sail for the wind.
Thank you very much. It's very eye-opening. Also, it reminds me of your earlier comment of every trajectory has, of course, to have some bespoke solution to the needs of a country, of a region. Moving back to DC, James, so from your global vantage point in DC, what are the most, maybe you can quote a few, the most effective levers to reduce harmful fragmentation? And how can international institutions, such as the IMF, ensure that financial reforms and standards are largely implemented in a way that foster greater integration in the current geopolitical and financial global landscape that we live in at the moment? James, please.
So I think harmful fragmentation can manifest in lots of different ways through regulatory divergence, market segmentation, barriers to cross-border investment flow. And it can increase transaction costs through limited diversification opportunities, and ultimately it can potentially be a risk to financial stability and growth. So it's definitely an important question. But standing back, I think it's useful to think about capital markets as a wealth of different interactions between different groups, different people, different types of actors, and those can meet in very different ways. And in some ways, we'll see those pushing together, and in some ways we see those pulling apart. So, for example, over recent decades, there's been a trend towards very large IPOs taking place in the USA. But at the same time, we've seen in more recent years a growth of private financing. So I don't think the picture is necessarily straightforward. But coming to your question about the role of institutions like the IMF, one of our functions is surveillance work, and looking to see whether countries are implementing common international standards in consistent ways, albeit taking account of their own markets and the risks that are within those markets. And those assessments are based in international standards set by the Basel Committee on Banking Supervision, the insurance agencies, the Financial Stability Board, and agencies such as IOSCO, the Securities Markets Association. So thinking about recent developments within the capital market space, we've seen significant changes in the international standards around fund liquidity and leverage, reacting to some of the pressures and market stresses that have hit the open-ended fund sector over recent decades. And that's now quite a critical part of many of the assessments that we carry out. We've also seen a development of crypto standards, particularly around stable coins, recognizing that the role that they might play. And those are now also quite integrated into the assessments that we do of macro-critical countries especially, but also across the board. So it can sound abstract, particularly when you're in industry. You've got this IMF doing these assessments of different countries. So why does it matter? It can reduce discrepancies, which create inefficiencies and therefore increase costs. It can promote stronger collaboration between national regulators, but also international agencies to ensure that there's sufficient oversight of systemically important institutions. Where appropriate, it can also support developing or integrated cross-border financial market infrastructure, payment systems, settlement systems, clearing systems to enable more seamless cross-border financial flows. And again, coming to the previous panel a bit, by aligning some of the accounting standards, risk management standards, potentially ESG disclosures, that can strengthen the commonality of investor confidence across jurisdictions as well. So I think every jurisdiction has their own challenges, clearly, and it's important that their financial markets are recognized for the different roles that they do. But by working from common principles to tackle common solutions to common challenges, I think that can help to bridge capital flows whilst allowing for those important national differences.
Thank you very much, James. We're now moving to Angelo, largely same set of question, fragmentation, impact on efficiency and liquidity, and on the other side, any views on solutions as the most effective path to ensure a smoother cross-border market functioning? Angelo, please.
So we operate essentially and principally across Europe. So we do know something about fragmentation. If we look at the government bond market in Europe, or markets, I should say, because it's not really a single market, it is a very diverse landscape across the member states, whether we look at size, rating, political moment, what I mentioned before, debt management office policies towards these things, degree of electronification of markets across the member states, and indeed the instruments employed to finance debt. It really is an exceedingly fragmented landscape, which for us to work in requires us to try and reconcile what can be consolidated, and that's mainly our technology, because we operate we work with almost all DMOs in Europe, and we do that on the basis of the same electronic trading system. But equally, we have to calibrate what we do based on the individual requirements and needs of each one of those DMOs. And I don't think there's much of a debate around the fact that does put a brake on operating at scale in terms of exploiting economies of scale. And therefore the impact on efficiency, whether it's efficiency of operation or indeed efficiency of interaction between the participants in the market. So it also introduces an obstacle to the adoption of standards, of common standards, again, which in itself is something that is important to make these markets more accessible and understandable to investors in general. I mean, it may keep people like me in a job, but that's not exactly a collective benefit necessarily. So standards are important in that respect because they do make things more inclusive. With respect to ways of solving for that, and whether regulatory harmonization or technology-driven solutions as a most effective path, I think again those two things need to be taken together and see how they interact. And let's remember that the financial services industry, while very reasonably technologicized, if that's a word, is also highly regulated. And because of that, and because it's much more regulated than the pure tech industry as we know, is dependent on regulation to be designed in such a way that, yes, on the one hand, and that's the purpose of financial regulation, it protects the investor, but equally to be calibrated to the point where it doesn't inhibit innovation and technological development. I think, we take as a specific example, you look at the fragmentation in Europe across the post-trading end of the value chain in trading. We have too many clearing houses, too many central securities depositories, T2S is incomplete, and that would be not a bad place to start. There are a number of others, but I think I'll stop there in the interest of time.
Thank you very much, Angelo. A very interesting set of comments. And we now move to the next block of our discussions. As we know, capital markets are also under pressure to adapt faster than ever before, as we heard. We now focus on innovation, sustainability, and resilience, which is intertwined also with the topics we touched upon before. There are a number of pressures faced by capital markets: technological change, rising sustainability expectations, and many others. So under the lens of adaptation, how can markets adapt without losing stability or investor trust? Because they're both important. And I turn to you, Mohammed, for this first question. So what's been your experiences with new asset classes like fintech-driven products or other new, more recent asset classes coming to your market? And how is Saudi Arabia leveraging innovative technologies such as blockchain or AI-driven trading platforms to enhance efficiency, accessibility of its capital markets as well? So if you can take us on this journey.
Maybe I can pick up on something that Angelo said earlier when he contrasted this notion of technology in its abstract form versus financial technology, and the fact that we are, as an industry, more heavily regulated, and this has implication. And that is, I would say, the defining characteristic of implementation of technology, at least in terms of transforming how the financial service sector is run. And if I can illustrate a little bit more. So the reality is, anything that is important gets regulated because it's too important for us to let it go on pure market forces. And this is good because maybe it protects some people, maybe we tend to over-regulate sometimes, but it also creates barriers to entry. It just so happens that the financial service sector in most countries tends to be the most protected. The reason is because it's also the most heavily regulated. And so this is a great moat for existing players to protect them from competition, but that very same moat is what is immunizing us from technology innovation. And I think the first memo that was received was a memo that was received to security market regulators themselves saying, we understand you have to regulate, you have to protect investors, but there is a level at which if you insist on a predefined scope of regulation, you are going to destroy innovation. And that's when the notion of sandbox and temporary experimental licenses started to come in. And that was a very new approach for financial regulators, because financial regulators were used to a one-size-fits-all. You know, I regulate you as a broker, and you operate forever as a broker, and I understand completely what you are meant to do from the beginning to the end. And it's only with these experimental permits that we started to say, okay, we understand we might not know the full picture. Let us know what you do today, and we're okay with it today. And as long as we have some constraints on how far you can grow or how fast you can grow, we will experiment in this together. Now, the good news is this approach has been massively transformative for the sector. And let me give you an example from Saudi. In Saudi, we have about 180, less than 200 capital market licensed firms. We have about 50 or 60 banking and financing and payment licensed firms. We have maybe another 100 insurance companies. Our fintech industry is larger than any one of us individually. It's larger than the capital market sector. It's larger than the banking sector. It's larger than the insurance sector. And it achieved this in terms of number of players. It achieved this in a matter of 8 years. The other 150, 160 were in a matter of 40, 50 years. So you can understand how much innovation has been unleashed as a result of this. Another data point I will add is we have one of the fastest growing venture capital industries anywhere in the world, and a full maybe 30% of venture capital deployments are in the fintech space. So it is very large in terms of number of licensed firms. It is also very large in terms of amount of capital it is attracting. The one thing where it is not yet large is in terms of revenue. The fintech space still represents less than 5% of the aggregated revenue of the industry overall. And so either we are still in an investment stage and we have not found the big unleash, or it hasn't scaled up, or we are prone for consolidation. But either way, both of these are a good thing, because it is the creative force in creative destruction, where without it, the industry calcifies and becomes quite stale. And we do see it. We do see it. We do see it in operating models. Let me give you 2 examples. Some of our most successful operating models in the capital market space, technology-oriented. One is robo-advisory, which is this notion of automated asset management. Rather than having an asset manager, you have an algorithm that builds it. What we have found is this has been one of our fastest growing area. And it's one of our fastest growing areas, not because it performs better than normal asset managers, just simply because users find it easier to deal with than dealing with KYC and AML and the 2,000 forms you need to fill out if you open up an account. And it is that level of innovation that, starting with a clean sheet of paper, can lead you to, rather than just filling the form for every platform. The second example is crowdfunding. Particularly debt crowdfunding platforms. One of our fastest growing fintech areas is debt crowdfunding, and I mentioned how we're moving from a net importer of capital, net exporter of capital to a net importer of capital. That's very much required, particularly for small and medium businesses. And I don't think we would have been able to reach the same quantum and same speed of getting capital out to small and medium businesses without innovating at the level of business models. The only drawback is, obviously, this innovation is great until the first problem happens. And then it is very difficult to stand in the way of sort of reversing public opinion.
Thank you very much for these data points and comments. Moving to Christopher, you mentioned earlier Hong Kong capital market being a green finance hub. Maybe you can comment on your strategy when it comes to digital assets, other types of assets, and what initiatives are you undertaking to expand, on one side, the sustainable fixed income sphere, but also addressing the growing role of AI-driven innovation in your markets as well. I think you touched upon several of these subjects earlier, but please.
I think before I get into the practicalities, maybe I can get a little bit more philosophical about how we approach these issues, in the sense that We talk about geopolitics, we talk about uncertain world. For example, right now, in fact, in Hong Kong, we are hit by the greatest storm of the year. So thank you for having me here so that I can avoid that. and also, we are lacking one panelist because of a cyber attack in one of the other airports. So it is indeed an uncertain world. But that said, I think there are three key themes that we are seeing in terms of the real economy that the capital markets should leverage. I think we normally say that as 3D model. Number one is about the need to diversify. This diversification theme is about, like, for example, in terms of where you want to park your wealth, and also what type of companies you want to invest in. And one thing that stands out, back to your point, is about technology companies. And in fact, back in the year 2018, our stock market launched a reform to introduce the biotech companies to list in Hong Kong. It was a time when people are highly skeptical about these companies because we were told that the result of these companies are highly binary. Either you get the license, they become successful, or they got nothing and fail. But that said, we have the right guardrails in our regulation. Like, for example, for the stock code of these companies, we put the letter B in the front. In such a way, people know that these are not B-grade companies, I don't mean that, but biotech companies. At the same time, we have to ensure that for these companies to list, they have to have certain cornerstone investors of quality, in such a way that already there are some institutional people interested and know how to value these companies before we dish them out for public subscription. So what I'm saying is that, in fact, if we try to have the right guardrails in place, a lot of this innovation can actually take place on the regulatory side. So it's about diversification. So another sub-theme about diversification is that, well, on the one hand, people want to invest globally and also invest in different industries in order to avoid having all eggs in one basket. They also have an increasingly strong home bias, in the sense that in an uncertain world, they want to keep things to themselves, in particular if things are valuable to them. And that's why in the policy address announced by our Chief Executive last week, we set out clearly that we want to grow our precious metal trading market in Hong Kong. Because we see that precious metal, be it like gold and silver, they are of tremendous value when it comes to uncertainty. People buy that as kind of safe asset. So it's something that we want to grow, and at the same time something that we see there's a need for government taking the lead. Because many of the players now globally, in terms of having these platforms, are all market-driven, are not government-run or government-managed. So we will have a centralized clearing platform run by the government, owned by the government, to clear these precious metal products. So it's another sub-theme under the first D, diversification. So another D that I want to mention is, back to your point, is about decarbonization. Even though we see a retreat on the US side about ESG and others, this theme is going to continue. Because back to Mohammed's point, countries have already committed to decarbonization and also to net zero targets. Like, for example, for Hong Kong, we have already committed as a territory 2050 as the year that will achieve carbon neutrality. So, in fact, we are one of the very few financial centers of the world to subscribe to the International Sustainability Standards Board disclosure requirements. And we have our listed companies, big and small, and also our financial institutions ready to comply with those by the year 2028. So it is something that we also be ambitious, yet at the same time being practical, because we understand that with compliance, there are costs. So that's why we will require the big companies to come out first to comply, and eventually the smaller companies with sufficient preparation for them to do so. So there's another D that I want to emphasize. The final D, back to your point about digital asset, is about digitalization. I had a debate with Mohammed yesterday about what exactly the economic value these kind of blockchain activities will bring. And if you look at how we test this out, the government, in fact, issued several tranches of tokenized bonds with the government as the issuer. And what we saw is that if we put that on blockchain, the settlement days of such bonds can be reduced from normally 5 to 1. So in fact, there are genuine economic value in terms of having high efficiency and also better capital deployment when we got the blockchain right. But of course, there are also limits in terms of potential risk. That's why what we have been doing is to ensure what we do is in line with the FSB requirements under G20. in a sense that if those activities are presenting risks similar to conventional financial activities, like the first panel under said by the Minister of Finance from Estonia, is about like anti-money laundering, anti-terrorist financing, or tax evasion, we have to ensure that the safeguards that we have in place are similar for digital assets as in conventional finance. Like, for example, one thing that we require our digital asset exchanges to do is to segregate their client asset from the exchange, and also ensure that the exchange operator will not involve in the proprietary trading on their own platform to avoid conflict of interest. So all these are actually financial regulation ABC, yet at the same time, we transplant them into the digital finance space, because we know that even though the finance as it is manifesting itself in different forms, the risks are highly similar. It's all about people, about human nature, about the desire to get money, to be greedy. And that's why the regulator has to be in place. At the same time, we are following international standards to make sure that what we do are something amenable to global investors.
Thank you very much, Christopher. Following up on these topics, I go back to James and go back really to the balance between encouraging innovation and safeguarding stability as primary role of regulation. So what are your views in terms of uneven adoption of, for instance, fintech and green finance standards?
So I'll just reflect on some of the questions earlier as well. You mentioned AI, and this is obviously a key technological development that has the immense promise to reshape the global economy, but also carry significant risks. This is one area that we've looked at, and we think it might actually support the further growth of non-banks. And although adoption of AI in trading and investment strategies at the moment is still fairly new, it seems to be growing quite rapidly. And we see kind of a developing risk there around although there are significant efficiencies to be gained, there's potentially less constraints on some non-banks than there are banks in utilizing that technology, and potentially some concentration risk as well. So I mention AI because I think it's so key, but I'd particularly like to come on to some of the comments Christopher was making around crypto and tokenization. Everywhere I go across the world at the moment, people are talking about stablecoins and tokenization. And in the US, we've got the CFTC, the derivatives regulator, consulting on 24/7 trading and derivatives markets based and linked to some of the concepts that have emerged in crypto markets. And we talk as well about stable coins. And I think in crypto sometimes there's a tendency to think that everything is new and completely uncomparable to anything that's gone before. But when we think about a stable coin, it's actually it's kind of a constant NAV fund, so apologies for the technicality, but it's trying to maintain its value based on a pool of assets, but then it trades a bit more like an ETF. And in the international world, the international regulatory world, those types of issues have actually been thought about quite a lot before, as though constant NAV funds, how do you actually mitigate the risks? What if that peg breaks? What if there's redemption pressures? So how this kind of changes markets 10 years from now, I think is yet to be seen. But Angelo, you mentioned earlier some of the inefficiencies as you see in the post-trade infrastructure. I completely agree that I think the post-trade processing of some OTC derivatives contracts can be a lot more manual than some people assume. So there are clearly opportunities. But striking that balance between efficiency gains and also ensuring that markets have appropriate protections is definitely the challenge for years to come. And coming to regulators, I think it's vital that regulators build that capacity internally. Everyone talks about crypto, but it's so important to actually understand what the technology is, to understand the scalability dilemmas of blockchain technologies, to understand what a stable coin is, as I referred to earlier. And also, when we talk about disintermediation, trying to make sure that disintermediation is genuinely that, where it's appropriate to be, and it doesn't simply replace incumbent intermediaries with new ones. And the vast majority of transactions in these markets do go through exchanges, so there's already intermediaries in place. I'd quickly mention finally as well, before coming more directly to your question, cyber. Trust in financial services can be there until it's not, and one of those reasons can be cyber issues, which I'm told has affected some of us being able to be here today. It's very present. But this is increasingly something that we look at as part of our assessments of jurisdictions, and as we see further development of technologies such as quantum computing, I think it's only going to become more important. I'll just finally conclude. You mentioned regulatory sandboxes earlier and innovation hubs. These can certainly be useful, and I think it's really important that when jurisdictions utilize this type of initiative, you wouldn't get in a car without knowing where you're going, and I think that should apply too. They can be incredibly useful for people within regulators to bring different functions together, and also bring the central bank and government in where appropriate. And it can be useful for answering questions with new types of firms, new types of technologies, to say, how does this fit? Is this an e-money firm? Does this particular rule that we've always had apply to this particular firm? And how do I, as a regulator, benchmark this new firm or new technology against incumbents when the business models are so different? So I just conclude by saying those sandboxes can be really effective ways to tackle those problems. But the real benefit can often actually come through ensuring that coordination within agencies and making sure that the eyes are on the goal of supporting innovation without unduly lowering standards.
Thank you very much, James. And I'm hearing that we are running over time. So my apologies, Angelo. I'm going to have to wrap up this very rich discussion now. I thought it was quite captivating and a very rich discussion. I hope the audience enjoyed it as well. I think what we heard today is really a mix of optimism about innovation and connectivity, but paired with caution and geopolitical shifts and systemic risks. I also heard a lot of interesting comments on the adaptability of capital market stakeholders in different geographies. We've heard about reforms that deepen trust, ways to connect region, and strategies for building resilience in the face of change. So let's carry these ideas forward as we continue exploring how Slovenia, now we move from the European level to the global level, and finishing on a high with Slovenia. How can Slovenia unlock the growth of its capital market, which you will hear about in the next panel. Thank you for your attention. Thank you, Phil.
Thank you, David, and thank you to all the panelists.
Thank you.
It was a very interesting discussion. And David, congratulations for your first panel ever moderating.